In this video, I will be sharing with you the 7 lessons that I've learned from investing in the stock market as a student. Hi, I'm Aldrich, a business and economics student based in the Philippines, and it's only been over a year since I started investing in the stock market. It definitely wasn't easy. Alright, so onto the lessons that I've learned. I've tried to organize it in a way that builds on the experiences that I went through, starting from zero, as in I did not have any knowledge at all about the markets, up until where I am today. So whether you are a beginner investor or trader like me, or you are a more advanced or seasoned veteran in the markets, I hope that you'll be able to pick up some knowledge or new lessons that you've never really thought about before. And I hope this video really does justice to that. So, onto the lessons. The first lesson I've learned is to start small and don't invest big immediately. I'm pretty sure that most of you in the markets today have experienced this in some shape or form, but let me share with you my story. So before investing in the markets, my parents initially discouraged me from doing so because of the debilitating stories that they hear from their peers. And that one story that really struck me the most was when one of their friends actually lost 50 grand investing in the stock market. And from then on, as they continue to accumulate the number of stories that they hear from their friends and peers, the common denominator from all of them was that the stock market is characterized by these two components. Number one, investing in the stock market is similar to gambling in a casino, and the second one is that it is a very risky endeavor. Because of these stories, my parents really tried to discourage me from investing all my well, it's not hard earned money, but it's the money that I've accumulated over the years from my allowance every week and also the gifts that I receive from the holidays. But I thought differently. I told my parents that I wanted to at least try to dip my toes in the water and see for myself what investing in the markets really is. So I decided to invest a tiny portion of my savings into the stock market just to see whether or not the stories being told by their peers are actually true. So if I fail, well, it won't really affect me significantly because, again, I did invest only a tiny portion of my savings. But if I do succeed in the markets, then this just goes to show that it is something that I can do over the long run. So you may be wondering, how well did I perform or how bad did I perform during the year? Well, my results blew past my expectations, and I wasn't really expecting that I would perform this well during the year. I ended the year with a return of 26%, which is a far cry from the return of the Philippine Stock Exchange Index, since the market that I really invested for the years only in the Philippine market where I am based in. The Philippine Stock Exchange Index, or the PSEi, actually incurred a loss of 0.32%. Because of these contrasting data, it really gave me the confidence that I needed to say that this is something that I can do for the rest of my life. If I continue to perform this well on a yearly basis, then I think that I can just really take advantage of the power of compounding. As what Albert Einstein would say, compounding is the eighth wonder of the world. The strategies I implemented in achieving this result is something that is applicable to all kinds of markets. So whether or not you are investing in the Philippine stock market just as I am, or in the US markets, or even the cryptocurrency markets, I hope that the succeeding lessons that I am about to share with you will be able to help you achieve a similar level as I did in the Philippine markets. Now, the next lesson is definitely something that you should keep in mind as you develop your foundation as a trader or investor. Lesson number 2 is to determine the trading approach or investing approach that fits your personality. Most of the courses that you see online would be about, short-term trading or even value investing, which is basically buying companies at a bargain and holding them for as long as you can because you believe in the company's story. Because of the proliferation of short-term trading courses online, my approach to the markets naturally gravitated towards short-term trading. But what I found out is that based on my statistics, the approach that works for me is to actually hold stocks longer than what is recommended by short-term trading. So, how do you find the trading approach or the investing approach that fits your personality the most? Well, right now I'll be sharing with you a framework that I used to guide myself to find that trading approach that works for me. Now, let me share with you the different types of traders that are participating in the markets. So, we have to divide them into two categories. So, we have the short-term traders and also the long-term investors. And under the short-term category, there are actually three types of traders. First on the list is what we call the scalpers. The scalpers are typically traders who would buy and sell the stock within minutes, right? So say for example, I buy 50 shares of Tesla in 1 minute, and then the next minute after that, I would immediately sell my position because I gained a profit from it. So that's how scalpers function. The next category of short-term traders is what is known as the day traders. As the name suggests, day traders are those traders who would buy and sell a stock within a day. Going back to the Tesla example, if I'm a day trader, I would purchase shares of Tesla, and no matter how volatile the stock is within the minute or within the hour, I will decide whether or not I will sell the position if the price does not breach my stop loss or if the price would hit my profit targets within the day. So that's how day traders would typically function. Now, the last type of short-term trader is what we call the swing traders. Well, among the three, the swing trader would hold the stock the longest in comparison to scalpers and day traders. So swing traders are traders who would hold their position for days or even weeks because they have a certain level of conviction towards the company that they are buying, which is why they still have that leeway to hold for a larger move as compared to scalpers and day traders, right? So that's all for short-term traders. Now we move on to what is between the short-term and the long-term trader or investor, right? So this is what we call the position traders. You may ask, what is the difference between a swing trader and a position trader? Well, the position trader would typically hold their position. It can be for days, but mostly they hold their position for weeks to months because they are mostly biased towards what they know about the company as compared to the daily fluctuations of the stock price. And finally, we have the long-term trader or investor, but mostly investors, right? So this is where the value investors would fall under. These investors would hold their position for months and years. They can hold it for 1 year, 2 years, 10 years, and 20 years. Think of Warren Buffett and Peter Lynch. These guys would do their analysis based on the company's fundamentals, right? So these are the financials of the company, what the company is doing, and is it a company that I can immediately understand the business model of? So that is how these value guys are investing their money. And what they like most is that they are buying the shares of a company at a bargain, which is why it's called value investing. So after seeing the different types of traders or investors that participate in the markets, I honestly think that there is no other way to determine who you are as a trader or investor but by actually participating in the markets yourself. But I don't want you to blindly participate in the markets and risking all of your hard-earned money or the savings that you've accumulated over the years, which is why you have to listen to the third lesson that I'm about to share with you today, because this is really the backbone of how I approach the markets. And after realizing this fact, it really changed the way I approach the markets. So the third lesson is to systematize your trading or investing process as early as you can in order for you to objectify the way you approach the markets. Now, I want to share with you another framework which I use to approach the markets, and this is what I call the PEJE framework. PEJE stands for plan, execute, journal, and evaluate. A common pitfall of traders and investors is to trade or invest companies without even understanding what the company does or without setting their entries or exits. Well, basically, without having a plan. So think of a doctor. If they don't have a plan on how they treat their patients, then what would be the outcome? Of course, it would be, the patient suffering because of the haphazard approach of the doctor to the operation. So we must treat trading just as how a doctor treats his or her patient. The benefit of systematizing your process is that you can replicate the profitable trades that you made today into the succeeding trades or investment you will make in the future. You don't want to be this trader, right? The bottom line is we must follow this framework in order for us to systematize our process. In this video, I won't be going through the in-depth framework that I follow, but I'll just be showing you the different guide questions that you can ask in order for you to follow this framework. In the planning part of the process, what usually falls under this is to determine what stock to buy. So under this question is, what would your screening process be? So how do I screen for stocks? So in screening for your stocks, you must follow certain criteria such as how good is the company in making revenues, how are they able to manage their costs, and etc. So aside from that, in the planning phase, you must also determine your entry, exit, and also how much am I going to risk in this trade or investment. So those are the two main questions that goes into the planning phase. So next is to execute. Now, there won't really be a question for you to ask here because it would only involve a click of the buy or sell button. So what mainly falls under this process is to gauge, is the stock price nearing my exit point or my exit price? Because from there, if you are using a broker that does not automatically set your stop loss, then it is important for you to monitor the stock. Well, depends. It also depends on the approach that you are going for, as I mentioned in the second lesson. Again, it would all depend on how you approach the markets as well. Okay, so going on to the journaling process. So what are the typical questions that you should reflect on? Okay, so for journaling, right, you must ask yourself, how well did I execute my plan? And how are you going to assess the quality of how well you executed, right? So it should be based on the research that you've done about the company. So do you know the company well? And also in terms of how you followed your execution strategy, right? Did you enter at the price that you wanted to enter, and did you exit at your exit price? So that is the main question that you should ask in your journaling process. And finally is to evaluate. So in evaluating your trade or your investment, you must ask the question, what were the mistakes I made in the process? And the second question to ask is, how can I improve my trade or investment in my succeeding trades? So this is only a very brief overview of my process, and I also plan to make a future video detailing this PEJE framework that I use. So comment down below if you are interested in seeing that. Okay, so let's move on to the next lesson. So the fourth lesson I learned is to keep it simple and don't overcomplicate things. Now, I actually found this meme a while back when this guy took social media by storm because of his nonchalant demeanor in the Paris Olympics. And I thought that it would be a great way to relate it to trading and investing. While the meme does show a good representation of how people approach the markets, it may also stir up some misconceptions about it. Having a sophisticated process in trading or investing may lead to inaction because there was probably one condition in your criteria that was not met. This mentality is harmful because there are so many opportunities that could be missed. On the other hand, if your process is oversimplified, then you could be making hasty judgments that would harm your portfolio. Sure, you may be getting some profits from time to time, but without having a systematic approach to the markets, these profitable trades would then be irreplicable. Lesson number 5 is realizing that technical analysis is overrated. What do I mean by this? When you look through different tutorials online on how to invest in the stock market, 90% of the time would you see that there are many gurus out there preaching the importance of technical analysis, and sometimes even, claiming that there is a holy grail strategy or a holy grail uh, technical indicator that would lead to guaranteed profits. Of course, technical analysis is important, but it shouldn't be placed on a pedestal that would guarantee you profits when you trade or invest in the stock market, because there are multiple factors that you need to consider which actually affects how price moves in the market. Aside from the law of supply and demand, you need to understand what is driving that supply and demand in the first place. Well, it is the people participating in the markets. And people in the markets would make decisions based on rationality or irrationality. And what is mostly pushing the price of a stock? And that is the institutions. These are the hedge funds, the prop firms, and other large institutions that are moving the markets, right? And these guys are what we call smart money because they have access to information that retail traders or investors like us don't readily have. So, aside from knowing that fact, it is also important for us to understand how market cycles and economic cycles work because these factors are also one of the driving forces behind the decisions of institutions and retail traders or investors. So, the sixth lesson that I've learned is probably my biggest takeaway for the year, and that is to learn how to become more optimal with my capital allocation. So what do I mean by this? Remember that in the first lesson that I've shared in this video, I showed you my performance in the Philippine stock market for the year. And when you compare the return of the Philippine stock market versus that of other markets such as the US market or the cryptocurrency market, you can see how the Philippines severely lagged behind these two markets. And if only I realized that it is also important to have accounts in the US market and also in the cryptocurrency market, then I could have maximized my savings and also invested in companies in the US or also in cryptocurrencies such as Bitcoin or Ethereum. But also, particularly in cryptocurrencies, the reason why I did not invest in them is because I really don't know much about them. So I realized that the following year, it is also important for me to widen my horizons and to also understand asset classes aside from the stock market. Last but not least, the seventh lesson that I've learned in my investing journey is to invest in my education correctly. Buying books is not enough because there's so many books out there that tell you to do one thing, and there are also other sets of books that tell you to do another. And the reason is because there's so many schools of thought in approaching the stock market. I remember this one time, which occurred when I was still starting out in my investing and trading journey, wherein I bought this technical analysis book, which mostly contained different names of chart patterns and also different indicators that tell me how I can assess stock market prices. And I tried out each and every indicator that is in the book. So, this is what my chart basically looked like. I was fortunate enough to have found mentors early on in my journey, and as a result, I was able to perform well in the markets. And I'm really grateful for discovering the importance of having mentors as early as possible. So, for those of you who are still starting out in your trading or investing journey, please find a mentor as early as possible so that you will not have to go through the harsh experiences that these mentors had to go through in order for them to learn how to survive the markets. Because most of these people who had to really figure out everything about the markets had to sacrifice multiple accounts that they initially had. I remember one of my mentors telling me that early on in his career in trading and investing, he initially joined different Facebook groups of people providing advice on which stock to invest in. And so, for quite some time, he followed the advice of these people. And as a result, he incurred a 90% drawdown in his portfolio. And because of that experience, he learned the importance of going through the research process yourself the hard way. So, for those of you who are starting out in your investing and trading journey, please find a mentor as early as you can. So, if you got to the end of this video, comment down below your investing or trading story as well as the lessons that you've learned along the way. This was Aldrich. Thank you guys for watching and see you in the next video. Bye bye.